Hey everybody, John King, and thank you for joining me today for Financial Friday. I am looking forward to this one. So first of all, I am recording this on the Friday before Halloween, so I am the Great Pumpkin today. What's funny is I actually have a American flag suit. And as I was walking up to my studio today to do this VA loan training, I thought, I really should have been wearing my American flag suit. But for people who are watching this live, it's appropriate because it's Halloween. But there's people going to watch this 6 months from now, learning everything I know about VA loans, and they're going to say, why is the guy talking about VA loans looking like a pumpkin? Well, that's why. So here we go. All right. So what I want to do today is really dive into VA and VA loan programs and how they work, and help you understand what is a VA loan, how does it operate, and how can I use it to best of my advantage. So we already have Kathleen popping in here. Hey, Kathleen, thank you for joining me. You guys want to see your name on screen, feel free to post in comments on whatever platform that you're on if you're watching live, and you get to see your name in the lights. So this one is near and dear to my heart. VA loans are really, my father was a veteran, and I think that, the people who serve our country, give everything or are willing to give all, and that is an honor to be able to serve those people. And I take that honor very, very seriously. So the first thing that I'll say is thank you for your service to everyone who is a veteran or has served our country or is currently serving our country. I appreciate you. We all appreciate you. And thank you for your service. So let's dive into the specifics. There's a lot to cover here, and I want to give you some real substance about VA loans, how they work, and what it looks like. So let's get started with why the heck does VA offer loans? This is kind of my view of it. First of all, what I said a couple minutes ago, veterans have dedicated a portion of their life to serving our country, and they deserve to be rewarded for that. And one of the simplest things we can do is to help them become homeowners with better terms than just about any loan program that's out there. A VA loan is one of the most forgiving loans that are out there. And they forgive a lot of things. And it is really in debt, paying back that debt that we owe to the veterans, to those that have served our country. And so let's talk about, kind of my view of, by the way, Brian. So yes, Brian Pizzissi has served as well. Brian, thank you for your service. Appreciate that. And Kathy is an Air Force brat. So yes, absolutely. I think that's something that is, we all have some tie to the military some way or another. And it's why I love VA loans, because it really is a great opportunity to help out those veterans. So I want to talk about kind of the general philosophy. If I were to just to describe to you, what the heck is the point of a VA loan? What is it? What is different about it? This is the general overview. I'm going to get into a lot of specifics as we move forward, but as a general overview, a VA loan allows somebody to purchase a home with no down payments. Now that's critical, because there are very few loan programs that allow you to purchase a home with no down payment. And a lot of people misunderstand that, though, and they say, well, that means I need no money out of pocket. That isn't necessarily true. A VA loan doesn't require a down payment. And if VA is charging you a funding fee, and I'll talk about the funding fee in a couple of minutes, then VA will loan you the money to pay the funding fees. But VA is not going to loan you the money to pay the normal lending closing costs. The normal fees you're going to pay for title insurance and appraisal and underwriting and all of that stuff, VA is not going to loan to you. So when you look at a VA loan, you are paying your closing costs unless you can get the seller or the lender to pay your closing costs for you. Now, as nice as I am, unfortunately, we are not a nonprofit organization, and so we are not able to pay your closing costs simply out of the goodness of our heart. So why in the world would a lender pay your closing costs? A lender would pay your closing costs because you're taking a higher interest rate than what the market requires. And the lender realizes, I'm going to make back, I won't make any profit up front because I'm paying the closing costs, but I'll make my profit in interest over the life of the loan. And the average loan's at least 5 years long, and so we'll make more than enough money over the life of the loan. in normal circumstances. Now, if you're watching this far into the future, then I've done a good job in promoting my YouTube channel, and this video has lived on in perpetuity. But things may be different down the road when you're watching this. But in 2022, we're in October 28th of 2022. And currently, interest rates have moved up very, very quickly. What that means is Wall Street investors, the banks, are not convinced that rates are going to stay where they are. Matter of fact, they think rates are going to likely fall in the next couple of years. I think so too. Well, John, why does that matter? It matters because banks realize they're not going to make their profit in interest over the life of the loan. They're really got to make their profit up front because it's likely this loan's going to get paid off in the next couple of years. And VA loans actually are highly susceptible to pay off because of something called an interest rate reduction loan that I'll talk about in a couple of minutes. So right now, getting a lender credit to pay for your closing costs by bumping your interest rate, almost non-existent. So how do you get into a home loan using VA without having a bunch of money out of pocket? Well, there's two other options. You can have the seller pay for it. Now, currently, that's a pretty common occurrence. And unlike 2 years ago, when it was almost impossible to get a seller to pay closing costs for you. So it is a very big difference when it comes to the times of where we are in the market, in demand from the seller to the buyer, and whether we're in a buyer's market or a seller's market. So, hold on, let me undo that. Didn't mean to do that yet. All right, cool. Oh, did it again. All right, beautiful. All right, so it depends on whether you're in a buyer or a seller's market. Right now, we're shifting a little bit more towards the buyer having strength. A year ago, it was a seller's market, and sellers were unwilling to pay closing costs. But a year ago, the lender could pay the closing costs. So there's ways to get into a VA loan with zero money out of pocket, but it does create some special circumstances that we've got to work through depending upon the market. The third way is to use down payment assistance. There actually are down payment assistance programs that work with VA loans, and that allows us to use the down payment assistance to pay the closing costs. But just recognize that's an extra loan, and you're going to have to pay that back down the road. So that big picture on a VA loan, it is zero down payments. There's no mortgage insurance. So the other small down payment loans are going to be your FHA loan, requires 3.5% down, but they also charge a high amount of mortgage insurance on a monthly basis. The other option for small down payments, USDA. USDA also charges monthly mortgage insurance. And by the way, even on a conventional loan, you can put as little as 3% down sometimes, but you're still paying a high amount of insurance that you don't pay any monthly mortgage insurance on VA. So it's a huge benefit as far as the ability to do no money down, or excuse me, no down payment, and having a lower monthly payment. And in general, VA interest rates are cheaper. Now, why are they cheaper? Because the federal government is backing the loan and guaranteeing that the bank's not going to lose money. It's actually the only loan program that's a guarantee that says you won't lose a single penny. We will pay back all of your losses. Every other type of loan, even mortgage insurance, works kind of like your car or your homeowner's insurance. It covers some of the losses, but you've got a deductible. We have a deductible with most mortgage insurance programs. Even with FHA, we don't get all of our money back. But with VA, we do. So VA is the safest loan for a lender to do. And therefore, we don't charge as much. So you get a cheaper interest rate most of the time on a VA loan than you do with a conventional loan. And finally, the general philosophy of VA is they're going to be pretty forgiving in a lot of things. We'll talk some more details as we go through the next 40 minutes or so. But the fact is that a VA loan will allow you to have lower credit scores. It will allow you to have less time since your bankruptcy or foreclosure. There's a lot of flexibility built into VA that allows for qualification when other programs may not allow for that same qualification. So let's dive into some of the specifics. So first of all, my computer's not cooperating. Hey, bear with me here. All right. So first of all, do all veterans qualify for a VA loan? No. So the challenge with VA is that there are specific rules. Those rules are on the screen. I'm not going to read them to you. You can read them yourself. You can look them up. Be careful, by the way, when you look up stuff about VA, because you get a lot of misinformation. And so when you look up a VA guideline, make sure you're on the VA website, either and something that ends in .gov. If it ends in .gov, it's accurate information. If it doesn't end in .gov, I don't trust it. So be super careful as you're looking up information. But if you look back at that slide that we were just showing you, essentially, there are rules that say, hey, you're able to qualify for a loan if you have been served for a certain amount of time during wartime or a certain amount of time during peacetime. And there's different time frames of when did you serve and when didn't you serve, and a whole bunch of yes, no, maybe type of questions. But here's the reality. The reality is that you simply get your certificate of eligibility, and your certificate of eligibility is going to tell you if you are eligible for a VA loan. So you can go on to VA's website, you can order your own certificate of eligibility, or I can order it for you. All I need is your DD-214. There's no fee whatsoever, but there's really two outcomes when you go to order your certificate of eligibility. The first outcome is that it's automatic. And that means that we literally put in your information into VA's portal and boom, I immediately get a certificate of eligibility. The second outcome is I don't get a certificate. Shocker, that's the opposite, right? But the second outcome is I don't get a certificate. That does not mean that you're not eligible for the VA loan. It means that maybe it's not updated. Maybe there's some unique circumstances where the system does not say, oh yeah, automatically this guy served for long, this lady served for long enough that I'm confident they qualify. So sometimes that has to do, for example, with someone who served for 1 day, but ended up getting honorably discharged for a service-connected disability. They hurt themselves on day 1, and it wasn't their choice to no longer serve, so they are still eligible for a VA loan. Critical to understand that fact so that when you think about getting your certificate of eligibility, don't sweat it if it doesn't pop up immediately. If you feel you qualify, we just fill out a form and we send it into VA. Most of the time, it takes them about 7 days to get me back your certificate of eligibility. The only time it takes longer than that is if there's a bigger challenge. Matter of fact, I haven't run into this in a while, but probably 10 years ago, 15 years ago, I ran into a fair number of people who were veterans that we had a hard time getting their certificate of eligibility because there was actually a fire. I want to say it was in Kansas City. There was a records facility that the military stored records of service for veterans, and there was a fire. And the fire happened prior, I want to say it was like 70s or something is when the fire happened. And a lot before they got digitized, those records disappeared. So there was like a 30 to 60 day manual process to do research when we end up ordering a certificate of eligibility for those people. That's super, super rare. I haven't run into that in a long time, but I'm just preparing you that the earlier you order your certificate of eligibility, the better off you are. It simply is your ticket to know that you can do a VA loan. Now, what does the certificate of eligibility tell us? It tells us that about your entitlement, okay? So your entitlement is the insurance policy. Now, just like a lot of things with the government, rules change, but the legacy information, it stays the same. Let me explain to you what I mean. The entitlement is the amount VA will guarantee. That's the insurance they will pay out to us, which is $36,000. So if you see $36,000 on your certificate of eligibility, you're golden. That means you can get as big of a VA loan as you want. Now you're going to say, wait a second, John, I don't understand this. And I'll get to it in a little bit in a second. But basically understand that the entitlement is the insurance amount that covers up to 25% of the loan. Because originally VA loans only went up to $144,000. So you had $36,000 of entitlement, which is 25% of the $144,000 loan. Then VA changed their rules and said, we'll go up to the conventional loan limit, in which case we just had to say, hey, if you have 100% entitlement at $36,000, then you can buy up to whatever the conventional loan limit is. But then in 2020, the rules were revised again. So I'm going to share my screen here and explain to you what the new loan limits are so that you can better understand those. And so what we'll see here, let's see if we can pull this up. There we go. Okay. So you should be able to see my screen now. And if you can make that a little bit bigger, I would appreciate it. Beautiful. All right. So basically what this says is that, hey, and you can find this yourself. This is on a VA's website. And it says eligible veterans no longer have any limit over $144,000, which means you do not have to pay any down payment and they will guarantee it no matter what. You have full entitlement as long as one of these is true. Either you've never used your VA loan, or you've used your VA loan and sold the property. That's critical, and I'll explain that one more in a moment. Or you've used your VA loan, had a foreclosure, but repaid the VA's losses. So let's pretend, their loss, you had $144,000 loss on the $144,000 loan that got foreclosed upon, and VA lost $36,000. If you paid them back that $36,000, then you can use your VA again. But that's only if your entire amount of your entitlement has been used. So let me explain to you a little bit more about what this means. It means you could technically, actually, I'm going to stop. I'm going to go back here. If you, and this is going to be pretty confusing, but I want to be clear. What it says is if you did a loan previously with VA and you've paid off that loan and sold the property. Now, why does it matter if you sold the property? Because the VA entitlement is still encumbered. It's still tied up to that property, even after you got rid of the VA loan. Now, how do you get rid of a VA loan? Well, you pay it off in full, or you refinance it into a conventional loan. But VA's rules are super clear. Your entitlement is still tied up because you own a property that you had previously done a VA loan on. So how do you get out of it? How do you do a new VA loan if you refinance out of your current VA loan and you kept that property? You ask for a one-time restoration of entitlements. And that one-time restoration of entitlements allows you to say, hey, I no longer have a VA loan on that property. Can you give me back my $36,000 available? And VA says, no problem. But you can only do that once in your life. So if that next house that you buy, you end up keeping and refinancing to conventional and want to buy another one using VA, they won't let you do it. So restoring your entitlement for a home that you had bought using VA or financed at any point using VA, and you still have the home, but you don't have the VA loan anymore, can only be restored once. So it's confusing, but it's important to understand. The other thing that I'll tell you, we'll go back over here to this screen, is you technically, I had a client, as a matter of fact, I have a client that is buying a house right now, and they have part of their entitlement was used before. They had a home that they lost in foreclosure, but it didn't eat up the full $36,000 of their entitlement. And so what you're allowed to do is you're allowed to use a portion of the remaining entitlement. And so it's really up to you working with a lender that understands how these things work. So just because if your entitlement says $36,000, you're golden. If it says zero, but it's tied to a home that you refinanced, we can do a restoration. If it's somewhere in the middle between $0 and $36,000, that's where we have to run some calculations to determine exactly how much you can buy and how much VA will cover. All right, so let's move on from there. What if I'm a spouse of a deceased veteran? So there's some really specific rules on how this works, and I'm pretty sure we got those rules up here. Yep, here we go. And the rules simply say, yeah, you can get a certificate of eligibility if one of these three things are true. The veteran's missing in action, is a POW, or died while in service or from a service-connected disability, and you didn't remarry, or if the veteran died while in service or service-connected disability, and you didn't remarry before 57 years old or before December 16th of 2003, or the veteran has been totally disabled and then died, but their disabilities may not have been the cause of death. Basically, let me simplify it. If you are the spouse of a deceased veteran and they died from a service-connected disability, either in service or after their service, and you have not remarried, you can use your deceased spouse, your late spouse's certificate of eligibility in order to use a VA loan. If you've remarried, you may or may not qualify. And if your spouse did not pass away from a service-connected disability, you do not have the ability to use their VA eligibility. So I'm simplifying that for you so that you understand a little bit easier. All right. So one of the questions that I get asked a lot is, John, I'm a veteran, I should always use my VA loan, right? Not always. Here's the deal. VA is always going to charge a funding fee. Now, I'm going to tell you in a moment how the funding fee works and what the funding fee is, but VA always charges some form of a funding fee. And if you're putting a really big down payment, sometimes a conventional loan makes more sense. Sometimes we're looking at 25, 30% or more down payment. You're smarter using a conventional loan than VA. So there are some other reasons why VA is still a good idea, such as the ability to do an interest rate reduction loan that I'm going to talk about in a few minutes. So don't take anything I'm saying as fact, but also don't assume you always need to do a VA loan because you're a veteran. There's actually a difference in cost once you use your VA entitlement once versus subsequent uses. And that really is a critical piece of VA's structure, is they say, hey, if you're using your VA benefit for the first time, the fees that VA charge are cheaper. But if you're using it as a subsequent use, and you're putting a really small down payment, they're going to charge more. And it has a lot of reasons behind it. In my opinion, it really is about VA is trying to help get veterans into their first home. They're not really trying to help veterans to build a large amount of investment properties, especially if you're putting really small down payments on all of them. As you continue to buy more properties and you didn't have equity from the first property to put into the second one, you're considered a little bit higher of a risk in VA's eyes. And so that's where they're charging you more. So let's dive into the funding fee and explain exactly what the funding fee is. The funding fee is VA's way to pay for the insurance coverage that they're providing. And what we're looking at here is on the left side, you're going to see for purchase or construction loans. And I'm going to skip right to the chart at the bottom. It simply has to do with how big is your down payment and whether it is your first time using it or a subsequent use. And finally, it has to do with, did you serve in the regular military or the Reserves National Guard? Now, if you did both, it's about how long did you serve in each one in order to get eligibility from that particular type of service. So what I mean by that is, if you served in the regular military long enough, and then you're also in the Reserve National Guard, you get the benefit of regular military. If you didn't serve long enough in the regular military, but you have served long enough in Reserve or National Guard, then your eligibility is based on your time served in the Reserves or National Guard. What you'll notice is the subsequent use is the same fee as long as you have at least 5% down or more. So it's really when you're putting less than 5% down that VA cares that you're using the loan for a second time compared to a first time. But these fees are added to your loan amount. So VA basically is saying, hey, we're going to require you to pay this fee, but we're not going to require you to pay it up front. We're going to include this fee in your loan amount so that you're paying it back on a monthly basis. Now, you could choose to pay the funding fee out of pocket if you didn't want to include it in your loan. But for a lot of veterans, if you're putting a small down payment, you certainly have zero benefit in paying a little bit extra to pay off that funding fee. Now, here's the cool thing, though. You are exempt from a funding fee if you have a service-connected disability that is recognized by the VA. So you'll see on your certificate of eligibility if you are exempt or non-exempt. And if you are exempt, then you don't have to pay that funding fee. All right, so let's keep moving along. What's the maximum loan limit for VA loans? You know what? There isn't one. With the rule changes that I showed you a couple of minutes ago, VA essentially has said, look, we are willing to loan you 100% of the purchase price, regardless of the purchase price. So you don't have a loan limit. So it is obviously up to your income and your credit and your debt load to determine how big of a loan I can give you, but VA is not going to limit you. So let's dive in and talk about some credit requirements for VA. This is where VA is very flexible compared with other loan programs, but it's also where it gets a little bit confusing. So the first thing I'll tell you is that VA has no credit score requirement. There is no minimum credit score for VA. So you're like, awesome, John, I have a 400 FICO score and I'm a veteran. I can do a VA loan. The answer is yes, but you have to find a lender willing to do it. Now, this is going to sound absurd. As a matter of fact, there's times when I thought it was absurd. VA guarantees the loan. So there's no way the lender is going to lose money. VA says you can do a loan no matter what your credit score is, but lenders are still on the hook. They're carrying the cost of the loan during the time that you are not able to pay. And if you do too many loans that are VA, and those loans end up in default all at the same time, you could collapse as a lender because you don't have them. You get paid back, but you get paid back in the end when the house is foreclosed upon. During the foreclosure process, you have to carry all of that cost, and it can bury a lender. So most lenders have a minimum credit score. The lowest I have ever seen is 500. The average lowest is really around 550. In a market like we're in right now, most lenders are at least 580. Some have a 620 cutoff. Now, we have a 580 cutoff, but I'm doing a loan right now for a veteran with a 550 credit score. So just because we have a cutoff of 580, we can make exceptions. The thing about lending, and especially VA, but really any lending, we cannot make our rules more relaxed than the main program, but we can make them tighter as long as we apply it universally across the board. And I know of no lender, I've never heard of any lender willing to do a VA loan below 500. Right now, 580 where we are at is pretty much the lowest that I'm aware of, but I wouldn't be surprised if there are people who will go lower. And we do make exceptions because we service these loans ourselves. So in most cases, you'll be making your payment to us going forward. And so if there's a problem where that loan's at a 550 credit score and we think it's a good risk, we don't have to worry about convincing another bank to take on that risk. We'll just hold that risk ourselves. So that's a great flexible benefit that we have when it comes to VA loans. So one of the other things is when you talk about credits, VA's rules are the same as FHA's. And that is if you are married and you live or are buying in a community property state, which California is, community property says that your bills are your spouse's bills and your spouse's bills are your bills. And so when, same thing as income, not income, technically it is, but we can't look at it that way. I'll explain that in a second. So when you're buying in a community property state and you say, I'm buying by myself, my spouse is not going to be on the loan, I still have to count your spouse's bills. I still have to count any credit cards, car payments, child support that's in their name. I have to count it against you. But I can't count their income unless their name is on the loan. And the reason why is because if they're not on the loan, I don't care about their credit score. So the benefit here is if I ignore them, I don't care about their credit score, but I do care about their debts. If you want to count their income, I have to care about their credit score. So that's why you might leave somebody off of a loan. Just realize you can't leave the veteran off the loan. Like if the veteran has low credit, we can't ignore that person. If the veteran has good credit and your spouse does not, we can take your spouse off the loan, but I have to count your spouse's debts. All right, so moving on from here, I believe we got a little bit more on credit requirements. Yeah, so this one's a big one. This one basically is giving you a sense of how VA is more relaxed than other loan programs. And I love this chart because it makes it super obvious how beneficial VA is. So across the top, we're looking at Chapter 7 bankruptcies. A conventional loan requires 4 years. FHA and VA only require 2. So VA is tied with the most forgiving for someone who has a Chapter 7 bankruptcy. For a Chapter 13 bankruptcy, we're looking at between 2 and 4 years on a conventional loan, 2 years on a FHA loan, but 0 on a VA loan. So VA wins as being the absolute most forgiving. How about a foreclosure? Same thing, conventional is 7, for FHA is 3, USDA is 3, VA is 2 years. So it is the most forgiving or tied for most forgiving. Even a short sale VA is the shortest amount of a waiting period. So when you think about having a challenge with your credit history, VA is going to be the most forgiving option out there. So when I said earlier that one of the benefits of VA is how forgiving it is, this is what I'm talking about. VA has the most forgiving guidelines when it comes to credit history, and it really is the biggest benefit when you're thinking about, hey, should I do a VA loan or not? You have small down payment. We'll talk about that again in a second. But the biggest thing is it's very, very flexible on your credit history, very, very forgiving. So that's a huge benefit. Let's talk about cash requirements for VA loans. So first of all, VA loans can replace a jumbo loan for any veteran who's doing a loan that has full entitlement. Jumbo loans are super strict, like credit score requirements over 700. You've got to have sometimes a year or two of monthly payments in reserves being extra money left over after paying your down payment and closing costs. Jumbo loans require 15 to 20% down as a minimum. But if you're a veteran, zero down payment, low credit score is okay, no reserves required. You're literally coming up not with your down payment, you're only coming up with your closing costs. And as I said, we can use a seller credit to pay for closing costs. So that's a critical area where when you're doing a jumbo loan, jumbo right now nationally in 2022 is anything above $648,000. Some counties have limits that go higher than that. But as a general rule, if the loan amount's over 648, it's jumbo. I tell you, a VA is an amazing product. For anybody who's looking to do a jumbo loan, you really should always use your VA program. If you otherwise, the cash requirements on VA loans are very relaxed. They're relaxed on how we document gift funds. They're relaxed on how we look at your reserves. We don't care. You don't need to have any reserves. So VA is very forgiving on a lot of things, and cash is one of those. All right, let's dive into income requirements for VA. So here's the deal. Every loan requires that we prove your ability to repay. So VA is not going to say, oh my gosh, you don't have to have a job, or oh my gosh, we're going to forgive these rules on the jobs. But they're going to be more forgiving about job transfers. They're going to be more forgiving about gaps in employment, but not to the point that it's irresponsible. So you have to be aware that there's a fine line, but in general, VA is going to be more forgiving in this area. But when it comes to jobs, one of the biggest things I run into is someone who's looking to get a VA loan after being discharged. Well, if you're discharged already and you have a discharge date, we know when you're going to be discharged, then we have to know that you have income continuing after that. And forgive me because this rule escapes my head. So I'm gonna tell you the general premise, but I don't remember the date, the timeline. Essentially, if your service dates, if your active duty is going to end within a certain timeline, I think it's a year. That's some data I'm forgetting about. Let's pretend it's a year. So in theory, I'll look up this rule later and get back to you if you have questions about it. But in theory, if you're going to be discharged in less than a year, we have to know that you're going to have a job, and we need to get proof of that job because we don't know how you're going to pay back the mortgage. Now, if you say, hey, I'm gonna re-up, great, then we just need proof of that because we need to know that you're going to continue to have income. Now, the truth is, if you're more than a year, again, I think it's a 1-year timeline. If you're more than a year away from ending your active duty, we assume, hey, you know what? We can't guarantee everything for the future. And so we're pretty flexible on that end. But if you're coming close to your discharge date and you're saying, okay, well, I'm going to be discharged in 2 months and I want to buy a house now, so I'm ready to live wherever I'm going to, VA, there's a VA rule says, no, we have to have the job lined up. Okay, that's super, super important. One of the things I want to talk about that I don't have a slide here, but it reminded me as I was looking at that is occupancy on a VA loan. When you are active duty, your spouse can serve as the occupant to represent you having it as a primary residence, but only your spouse. So let me explain this to you. If you are, currently at Travis Air Force Base and you are buying a home in Lodi, well, that's within a reasonable commute distance. But if you say, you know what, my wife lives in Los Angeles and I'm at Travis Air Force Base, and I don't want to buy a house in Northern California. I want to buy a house in Southern California. That's where she's at. And ultimately, when I'm discharged, I'm going to move to Southern California, and that's where I want to live. My wife will live there now, even while I'm on active duty. No problem. We can do a VA loan for you, no problem. But if you said, my mom's going to live there now, or my girlfriend's going to live there now while I'm on active duty, because VA will only loan on a primary residence. So if you're not buying near where you're stationed, the only way you can use VA to buy a home outside of commute distance of where you're stationed is if it's your spouse. Otherwise, no other family member, friend, significant other can occupy on your behalf. That's a critical rule to understand. All right, so let's talk about appraisals. This is one of the biggest myths, a little bit of truth, mostly myth, about VA loans and why they're a challenge. Because the appraisal process on VA is, oh my gosh, it's so challenging and it's going to create nightmares, and sellers don't want to accept offers on VA loans because of the appraisal process. The other reason they don't want to accept it is because of pest inspections. The third reason they don't want to accept offers is because there's fees the seller has to pay. Well, the truth is there are no fees the seller has to pay anymore. And I'll talk about pest inspections in a moment. But if you thought that there were fees the seller had to pay, that is no longer true. If you thought, well, I don't want to go VA because the appraisal is a lot more strict, it's a little bit more strict. It's on par with an FHA appraisal. What that means is the property has to be fully functional. Now, complete. So an example of something that may be a problem for VA or FHA that wouldn't be a problem for a conventional loan is a property that was missing baseboards. Who really cares if the baseboards aren't there? But if it's clear there's supposed to be baseboards and there are no baseboards, FHA and VA are going to say, no, that's incomplete. The work has to get done. So when you get an appraisal done, the appraiser is going to come back and say, did the property meet VA's minimum property requirements? So if it doesn't meet minimum property requirements, somebody's got to do the work before close of escrow. Or if the work is minimal, then we will allow something called an escrow repair holdback. That holdback allows for either you or the seller to put up 150% of the repair cost. So let's say it's $4,000 worth of repairs that have to get done. Then somebody's got to put up $6,000. We hold the $6,000, you close escrow. In the first week after escrow is closed, that $4,000 worth of work has to get done. Assuming there's no cost overruns, when we have proof the work is done and the appraiser has cleared everything off, then we refund back the additional $2,000. If there's any cost overruns, we have the extra money there to cover those cost overruns. So we have ways to solve problems with appraisals on VA loans, and it's really not something to be afraid of anymore. Here's the other thing about appraisals, and it really has to do with property, and that is property type. So VA will allow to do manufactured homes. You can do single family up to 4-unit properties, and you can do condominiums. But the condominium has to be approved by VA. So there's a special list that we can pull up for condos that are approved by VA, but if it's not an approved condominium project, then we cannot do the loan using VA. So something critical to understand. All right, the next thing I want to cover is pest inspections. So this is a trick, a option, a workaround to the challenges with pest inspections. So first and foremost, VA is going to require a pest inspection, and it's regional, meaning that some regions are not high infestation. California is, so anything in California is always going to require a pest inspection. There are some states that won't. I don't know which ones they are because I do my business primarily in California. But the point is, plan for a pest inspection to be needed. By the way, no other inspections are required, and we don't want to see them. So if you do a home inspection, don't show it to me. You do a roof inspection, don't show it to me. Foundation inspection, don't show it to me. Do you get the theme here? Don't show it to me. The only thing I need to see is the pest inspection. Here's the problem with pest inspections. The inspector is looking for anything that is active infestation or could, in any set of circumstances at some point down the road, lead to active infestation. Water, by the way, is the biggest water dry rot on the wood, but really dry rot comes from water. So any source of water leakage or potential water leakage is what is called a Section 2 item, or something that potentially could lead to a future infestation. Well, it's something, the next two words I'm going to give you are my least favorite words in the mortgage world. And those two words are underwriter discretion. I hate underwriter discretion, because with underwriter discretion, I cannot tell you, hey, this is your option. This is what it's going to look like, because it's up to the underwriter to decide. And so with underwriter discretion, the underwriter gets to choose which items they want to require. And they could require a loose toilet to be reseated, anyway, to be fixed. A loose toilet can lead to water leakage, but really, what are the chances? So we have a form that is actually created by VA. It's a single page, and it's a bunch of yes/no questions. And it says, do you see evidence of any infestation? And if they check no, then it's not required to say anything else. And it really simplifies the report, so that we don't have the appraiser or the pest inspector commenting on covering their backside. Hey, we think this and we think that. That creates more opportunity for work to need to be done. And instead, with a VA loan using this one-page form, we minimize the chances that work has to get done. The challenge is finding a pest inspector willing to use our form. A lot of them, for liability reasons, say, nope, I don't want to use your form. I'm going to require that we use mine. So ask if they're willing to do both. Like, well, hey, use your form, but will you also fill out ours? Most of them will say yes. I haven't found many that will say no. All right, so here's a question. By the way, if you guys have questions, please feel free to jump in and ask those questions. So no matter where you're watching, whether you're watching recorded or live, jump in and I'll answer the questions as they come up. So one of the questions I get is, can I get more than one VA loan at a time? Maybe. So part of it has to do with how much of your entitlement was used up. So if you bought a house that was less than like half of what the conventional loan limit is, then you only used half of your entitlement. And then you moved. If you're active military and you got PCS to a new location, and now you are you're stationed somewhere else, then you are now able to buy another home in that new community, but you've used half of your entitlement. So now you can only buy a home with a loan amount up to half of the conventional limit in that particular region. There's no limit at all as long as you haven't used any of your entitlement. But so again, it's a little bit confusing, but it can be done. It isn't common. So typically you need to pay off the VA loan. And if you didn't sell the property, you get a one-time restoration of your entitlements. And I talked about that a little bit before, but I want to remind you that when you refinance a home out of VA, your entitlement is still used up until you sell that property. But you are allowed once in your lifetime to restore your entitlement from a home that you're retaining. VA will do that, no problem. We will submit the paperwork to them to get that done. But remember, that's a single use only. All right, let's talk about seller credits. This is actually really important in today's market, because seller credits are becoming a more valuable tool, especially as rates have gone up. We're using seller credits to pay for closing costs, but also using seller credits to buy down your interest rates. And VA has some really cool ways that we can use seller credits. And I think we have a slide on this, don't we? Maybe not. Anyway, I'll talk. Yeah, here we go. Perfect. All right. So VA will allow up to 4% of the purchase price as a seller credit. But that's actually quite misleading, because VA, Anna, can you make that bigger for us? So VA basically says, hey, there are certain fees that apply towards the 4%, and there's other fees that don't apply towards the 4%. And I want to take a quick minute and read through. So these 6 bullet points right here do apply towards the 4%. And that is the buyer's funding fee, paying their taxes and insurance. By the way, the seller can actually pay for gifts to the buyer out of a seller credit, such as a television set or a microwave oven. They can buy down the interest rate further. They can provide escrow funds for temporary buy downs. And this last one is really a big deal. They can pay off, the seller can use a seller credit to pay off credit balances like credit cards and car loans and or judgments on behalf of the buyer. Let me say that again. The seller is allowed to pay off the buyer's debts. On a VA loan, you can use a seller credit. So if your buyer has too much debt and their debt to income ratio is off, we can negotiate a seller credit and use the seller credit to pay off the borrower's debt, to pay off the borrower's car, to pay off the borrower's judgments. And that is allowed in total up to 4% of the purchase price. That's a huge benefit. No other loan program allows for you to use seller credits to pay buyers' debts. That's a critical thing to pay attention to as we're looking to try and help people qualify as interest rates are moving up. Hey, they can essentially finance in up to 4% of their purchase price to pay off their debts. They're buying a $500,000 home. They can get $20,000 from the seller to pay off their debt, to pay off their credit cards, to pay off their car loan. That's a really cool way to negotiate, to A, help somebody qualify, and B, to help somebody to be set up for success. And it's something we don't do anywhere near enough, and it's a huge opportunity here in late 2022 as we've got a market that is seeming to favor buyers and give buyers some strength in being able to ask for seller credits. This is a really, really big one. Then over the 4% for all the normal closing costs. So, the customary fees, the customary closing costs that exist, we can pay for those over the 4%. So my next screen here says the same thing. So let's go to the next slide. So that 4% limit does not include normal discount points, does not include payment of the buyer's normal closing costs. So you can get a much larger credit. You can basically get a 4% credit to pay off the buyer's bills, okay? 4% credit to pay off the buyer's bills, and then you can get another 3% to pay the normal closing costs. That's huge, and that's a huge opportunity for us to take advantage of in today's market. All right, so let's go on to say, can I buy with someone who isn't a veteran? I get that question a fair amount. So the first thing is yes, but you don't get all the benefits that VA has to offer. So we talked about the fact that VA's guarantee is 25% of the loan amount. So if you're buying with a non-veteran, then you have to put 12.5% down payment because VA will only cover half of the entitlement, not the full amount. So a lot of times I run into people who say, hey, I want to buy a house and we're not yet married. My fiance and I want to buy together and I'm a veteran. Okay, is your fiance a veteran? No. All right, do you want to put 0 down or do you have some money to put down? No, I can put 15% down. Perfect, then we can do this for you. But if you say, no, I have 0 down, then your options are to not do the VA loan and instead go with USDA or FHA, or get married before close of escrow. You actually can buy the house, be in process of buying a house, run down to the justice of the peace and get married the weekend before you close escrow on the house. We would condition the loan that says we want a copy of the marriage certificate before we close escrow. But yes, I've talked some people into getting married quickly because it allows them to accomplish their home ownership goals. The truth is, I've also talked people out of getting married because I said earlier that you have to include your spouse's debt when you're married, even if they're not on the loan. So if you have a situation where you're about to get married and your spouse has a lot of debt, your fiance has a lot of debt, maybe you don't want to get married yet. Maybe you want to buy the house first and then get married because it gives you more flexibility when it comes to when you have to count somebody's debt and when you don't. So yes, I have talked people into getting married faster. Yes, I've talked people into slowing down how quickly they get married. And really, it's more about how do we help you accomplish your goals. All right, let's talk for a couple of minutes. We're about out of time. I got about 10 minutes left. If you have questions, please feel free to post them up. Let's talk about refinancing. So first of all, VA is really, really good about having an option to help you in refinancing your home. Very, very flexible, and I'll explain some of those criteria. But what I want to really point out is VA is going to mandate that you wait 210 days from the last time that you, from the first payment date of the most recent loan you did. And it doesn't matter if that loan was VA or not. So let me give you an example. Let's pretend that you bought a house 6 months ago, and now you put 50% down, and now you want to refinance and you want to borrow 100%. You want to pull cash out up to 100% of the value. VA is the only loan that will let you do that. So you're going to refinance, paying off your conventional loan to do a new VA loan. VA will not allow the new loan to be done unless it's been 210 days or 7 months after the first payment was due on the current loan we're paying off. So if your new loan is VA, it doesn't matter what your old loan was, you have to wait 210 days. Now, one of VA's coolest features is something called an IRRL, or an interest rate reduction loan. I'm going to give you a brief overview, and then we're going to talk about some of the specifics about it. An IRRL basically says, look, VA is already on the hook for your guarantee. And if we can lower your monthly payment or make your payment more stable by moving you from an adjustable rate to a fixed rate, then VA's risk has dropped and they're willing to do the loan for you with very few questions asked. We rarely do we need to pull credit. We don't really care what your credit score is. We don't need to get any proof of income in a lot of situations. We don't need to get an appraisal done. So if the value of the home drops, VA says no problem. We don't care if you're upside down. The truth is we're already on the hook to pay this back. Therefore, you can do it without having to have an appraisal done. The funding fee is a lot cheaper. It's only 0.5%. And VA lets you include all of the fees into the loan. So basically, you get a VA loan, and it's one of the reasons why, as rates are up right now, if you have the ability to do a VA loan now, you should, because you can refinance that regardless of what changes in the future about your credit, your income, or home values. You could refinance that as rates come back down on the other side of this economic cycle we're in, and you're going to be able to get a lower interest rate regardless of home values or anything else. So an IRRL is a really, really good option. So let's talk about what are the rules for doing an IRRL. So again, an IRRL is a loan that is for an existing loan to lower the interest rate. None of the stuff is required. So it is way, way more flexible. The closing costs can be included in the loan. The key is that you have to have the benefit to you of recovering your fees in the first 3 years. And I'm actually super glad that VA put this in there, because years ago, people would convince veterans to refinance, and they'd say, oh my gosh, you should refinance. We can save you $100 a month, but it's going to cost you $10,000 to do it. Don't worry, you'll make that back up. It's a 30-year loan. You're going to save, $3,000 or $30,000, $36,000 over the life of the loan. Yeah, but I'm paying $10,000 and I'm probably not going to keep the loan for that long. So VA added a rule that said we have to catch up or recoup your upfront fees, even if they're included in the loan. Whatever fees are charged have to be recovered with monthly payment savings in the first 3 years, or the first 36 payments. So let me say that in a different way. When you have a VA loan and interest rates fall, VA now requires that you have all of your fees made up in monthly payment savings in the first 3 years. So if it's going to cost $10,000 to do a loan, you have to save at least $277 a month in order for that $10,000 to be recovered in the first 3 years. Because the average person keeps their loan for 3 to 5 years. And it's predatory. When somebody tries to convince you to do a loan simply because you can, all it's doing is lining their pockets, and it's hurting you. So if you don't make the money back in the first 3 years, you really shouldn't do it. All right, last thing I want to talk about, can I use VA to pull cash out of my home? The answer is yes, you can. And VA is one of the most flexible programs when it comes to pulling cash out of your home. VA will let you pull up to 100% of the value of your home. Now, is that a good idea? Not always. If prices drop a little bit, you can't, right? If you borrow 100% of the value of your home, you can't sell it without losing money, because you got to pay realtors commissions. So I don't like the idea of it, and neither does VA, which is why they actually created 2 tiers. They created the 90% tier and then the 100% tier. So yes, you can still borrow 100%, but the rules are more strict. The guidelines are tighter. The interest rates and fees are higher. So the normal VA loan, the best VA loan comes when you're borrowing 90% or less when you're pulling cash out of your home. Now recognize that VA is greater in loan to value than any other loan program. Conventional and FHA loans require that you have at least 20% equity when you're pulling cash out. VA requires only 10, and really you can get away with 0, but they kind of frown on it. They're discouraging people. And so it is better if you limit yourself to 90% of the value of the home when you're pulling cash out. The truth is, it's better if you just don't pull cash out of your home. Now, I'm not telling you that you never should, but be careful about treating your home like an ATM machine. Just because you can doesn't mean you should. So I'm always cautious about that. I want you to be cautious about that. But if it's necessary, if it helps you improve your financial situation considerably, it's a great feature and it's a great opportunity. All right, the last thing I want to mention, just if you happen to know anything about the mortgage world, for every loan program other than VA, there's 3 types of loans. You can purchase, you can do a rate and term refinance, or you can do a cash out refinance. Well, VA doesn't have something called a rate and term refinance, because in VA's world, you have 3 types. You have a purchase, you have an interest rate reduction loan that can only be used if you currently have a VA loan, or you have a cash out refinance. So if you are refinancing from a different type of loan into a VA loan, then it's a cash out refinance. Okay. So just be aware of that fact, that it's a little bit a different type of structure and naming conventions, but essentially we can do all of the same things with VA as we can with any other type of loan. All right, gang. I want to see if we have any questions. Looks like Kathy has a question. So, or a comment maybe about the whole cash out thing. So Kathy, I agree. She says, lots of people have lost their homes because they borrowed against them. I agree with you completely. I'll also tell you, lots of people have lost their homes because they end up unable to pay all of their debt, and they end up in deep trouble because they have collections and judgments and other things that are placed against their home. And so to say, and I know you're not saying this, but I want to be real clear, to say don't pull cash out of your home because that means you're going to lose your house, sometimes it's the best way to do it because it lowers your monthly payments significantly. I have somebody right now who's refinancing to pull $100,000 out of their home, and the rate's going up from 4% to 7%. But it's because they have a high amount of unsecured debt that they got stuck in some circumstances and ran up that debt. And their only option now is to pay it all off or to file bankruptcy. And for them, bankruptcy is not an option. And so they're pulling the money out. It's saving them about $1,000 a month by doing so. And so it's a case-by-case basis, but I agree completely. Gang, we're just about out of time. There's about 7 or 8 of you still on here right now. So if you have questions, comments about anything, I know that there's a lot that I covered. VA is an amazing loan program, and I know how they work, and I'm really good at them. And so if you have any questions about anything, please feel free to reach out. Otherwise, I'm looking forward to taking great care of you. I appreciate everyone who served our country. I appreciate your sacrifice that you've made for us, and I will do anything I can to help you make your homeownership dreams come true. So thank you, everybody, and I hope you have an absolutely wonderful day. And by the way, next week we are doing a video on property taxes. So our Financial Friday, next Friday, is going to be about everything you need to know about property taxes. Property tax bills are hitting right now. People have lots of questions. How are property taxes calculated? How do they work? What's a supplemental bill? All of that stuff. Can I transfer my property taxes from one home to another? We're going to cover all of that next Friday. So join me next Friday, the 4th, same time, 12 noon for Financial Friday. I appreciate all of you, and I hope you have a wonderful weekend. And